Japan is broke, the UK is broke and in turmoil, energy prices are going sky high, Elon Musk is buying Twitter, but the government might intervene, and if they don't, he's gonna fire 75% of the employees. Meanwhile, bond markets are exploding with their yields, and alarm bells of a recession are going off everywhere. So the real question is this it? Is this the pain that we were promised? Is this the moment where we should be looking to buy the bottom? Or is there a lot more pain in the future? Well, today I'm going to give you the full overview of how the economy is taking shape and identify 3 key factors that need to be present for us to recover as an economy. And when these things are in place, I'll be ready to buy aggressively. This is a complete guide, an ultimate guide to the 2022 inflationary bear market that we're in and when to buy. With that said, if you're enjoying these videos, I've been seeing amazing comments on all the videos lately. Smash that like button. It takes 2 seconds and it shows both YouTube and me you enjoyed the content. Make sure to subscribe because very soon we'll be getting into the nitty-gritty of how to position around this once in a generation, probably once in a lifetime market cycle that we're going through right now. The biggest thing that we have to understand is how different this crisis is from previous ones. We have inflation going crazy, energy crisis, escalation between Ukraine and Russia, but most importantly, we have this sovereign debt crisis, which is what the videos I've been covering over the last few weeks have really been going into. And the main thing I want you to remember is that something will eventually break because of this. It's just not going to happen immediately. More on that later, and that's why you have to watch this one all the way to the end. In the last few weeks, things have been going really fast. We have faith in the Bank of Japan gone. That's because they're now intervening in their own bond market, buying back the bonds and repricing those yields lower. But guess what's happening? The yields are still creeping up and the Japanese yen is going down into the abyss. So they're devaluing the currency and they're not even stopping the issue with their sovereign debt. This is scary stuff. We have Germany experiencing 45% year over year PPI inflation. That's the producers inflation index, which is shocking to say the least. 10-year yields, again, this is part of the sovereign debt crisis. This is the highest since 2008. You guys know 2008. Of course, energy is in a tough position, as well as the UK CPI year over year at a 40-year high. Now, miraculously, we have some rhetoric coming out of the Federal Reserve that it's time to start talking about slowing rates. Meanwhile, that doesn't really seem like it's what's going to happen. So is this just some political jargon to keep things from falling off the rails? Because the only parabolic thing this year is the actual yields you're getting on long-term treasury bonds, which are now hitting a staggering 4.3% for a 30-year treasury bond. Just to be clear, mortgage rates were only like 3% all of 1 year ago. So if you bought a house with a 3% mortgage rate and now you put the exact amount of money that you owe into a 30-year treasury bond, you'd actually be making money for those 30 years. Your house is completely paid for. That of course would have required incredible foresight, but hey, that's the reality we're in, is that 30-year treasury bonds are now making 4.3%, 9% almost over 2 years if you get to the shorter treasury bonds. This is moving way too fast and money is becoming too expensive for the economy, which is probably going to cause something to break soon. Meanwhile, turmoil in the UK continues with the newly appointed Prime Minister Liz Truss resigning after just a month and a half. It's the shortest Prime Minister in British history, and apparently we're going to have a re-election of the Conservative Party. People are speculating that Boris Johnson could be coming back. And so of course the memes are rolling in, as you can see, perfect for short stays. This is the Prime Minister's house in England. Yes, this is funny, but also not funny. And in a chart, you can see this is how badly bonds have crashed since 2022 began. This, to me, is a huge bubble popping. And this is what we're going to be discussing in length at the end of the episode. This is what we're talking about with stuff breaking. And this is what we could look for when we see the Fed blinking, which is really what we're going to want to see. And I'm going to tell you the 3 things. It's going to make it simple to understand when things will change around. But the problem is the economy is not slowing down. The stock market has so much dip buying, animalistic spirits, as my guest Darius Dale on the last episode was talking about, and that's because people are confidently buying the dip. As Mega Double Chin Capital says, do people even know what the bond market is? As Dylan Leclerc points out, bonds just can't catch a bid. Cannot understate how big of a deal this is. Not only is the cost of capital repricing upwards, but the collateral underpinning the global financial system is melting. This is going to be so ugly. Bonds dictate how expensive it is to get money into the world, and bonds are also the debt that finances the world. Without that debt being valued, being bought by the public, there will need to be a corrective action by the government, and that is precisely something that we're going to be looking for. And I'm going to explain exactly what that means at the end of the episode. We talked a lot about it with Darius, but this is the stuff. This is the crux. How it's going to send Bitcoin back up, how it's going to send stocks back up, how it's going to send your precious JPEGs back up. These are all risk assets. And eventually there will be a pivot here, and we'll explain exactly how that should look. Now, of course, you know how much I hate when people say things are priced in. No, it's not priced in, okay? It's not priced in. Nothing's priced in. And some of the quotes that I'm going to share with you today, to me, are quite staggering because the cost of bonds is pushing mortgage rates up. The borrowing cost of money is going up, so the cost of actually owning a home is going way up. This means that the price of houses need to come way down because the amount of money you can afford to borrow is getting less and less and less for each dollar you have. So housing's going to come down, and this is going to make people feel way less wealthy. The vast majority of Americans or people all around the world value their wealth in the value of their house. When the value of that house starts to come down, well, people feel like they're not as rich as they once were. They stop spending as much. That affects earnings on the stock market, and then we get this downward spiral effect. And this will happen as long as rates continue to get pushed up aggressively to fight inflation. Now, remember the Fed's Daly, who was just talking about lowering interest rates or at least slowing down on the hikes. Well, it's important to realize, as Carlo Cassio points out here, that Daly is not a voter, and the data will not support a step down to a 50 basis points hike in December. It actually looks like, according to KKGB here, that there's some concerted jawboning here, some rhetoric coming out that is trying to weaken the dollar short term and ease some pressure, using words to fool people into thinking a pivot might be near. And as you can see, it's working here in the crypto sphere. People are arguing as to whether the Fed is actually going to control inflation or stop raising rates. But as Darius Dale just points out here, this is again just a short-term relief that will only extend the pain. You see, remember when I did that episode about how retail needed to capitulate? Everyone just needs to capitulate in order to end the pain. We need more pain to stop the pain so we can actually squish demand and move forward with lower inflation. Well, guess what? We're having the worst case scenario by extending this pain and having it drip slowly into the economy. We just need to rip the Band-Aid. We need to go through the hard part quickly to emerge quickly. Otherwise, this whole episode just gets extended in the amount of time it's going to take. It's already been almost a year, and it feels like, from a time perspective, that things are really only just getting started, considering how sticky demand is and how strong the economy remains. Now, to emphasize this, Wifey believes over the next 18 months, housing prices are going to fall to Hades. People are hoping and praying this does not happen, but once their retirement funds and pension funds are wiped out, people will have no choice. It will be the last asset class to bottom. We will be there accumulating. Now, this is exactly what I've been talking about a lot on my Twitter Spaces. I highly encourage you all to follow me on Twitter. I've been giving up-to-the-minute updates, doing live hour-long sessions with some really amazing folks here every morning, having the Web3 Show here, 9 a.m. Pacific, Monday through Thursday. So every day at 9 a.m., come hop on Twitter and chat with me live. We have some amazing guests, amazing insights, and I highly encourage you to follow Pio, who's one of my co-hosts here, and Nifty Nick. It's a really great panel, so make sure you show up every morning, 9 a.m. Pacific. We talk about everything from macro, crypto, bonds, Web3, NFTs, gaming. It's a full spectrum, and there's just an amazing conversation. So please check it out. We've been putting a lot of effort into that, and you can get more content from me that's in a totally different format. The point is, I've been harping on the wealth effect that people feel as housing prices go down. And to be honest, I don't own property yet. I'm looking to buy some, but it just feels totally mispriced, totally illogical. So I'm waiting for a housing crash where I could buy something maybe in cash, not take out a big loan, buy something sort of affordable, and not have to have a lot of debt. And then maybe when interest rates come down in the future, in a couple of years, I'll refinance that. That's my play on housing. I've been talking about that a little bit on those open spaces where there's a bit more flexible time for content. Again, let me know in the comments section below if you want to hear about more strategies beyond crypto, like how I'm going to approach the real estate crash that looks like it's coming up in the near horizon. And again, we have an election coming up in November. And after that election, we have winter, where we all know the need for energy and oil is way higher to heat homes and all that jazz. Well, guess what? We have the memes rolling in about the use of the Strategic Petroleum Reserve, which is of course running low day over day. We can see that this is the biggest drop in pretty much 4 or 5 decades that we've seen the Strategic Petroleum Reserves get down to only 20-something days of reserve. So this is a very, very interesting thing. And after the election, the cost at the pump, if the SPR does end up running dry a bit, could end up skyrocketing. This could end up sending inflation to a whole new gear. Again, not trying to fearmonger. I just want to prepare you for when people really feel the pain and stuff actually breaks. That's when we could see potentially a bottoming of these markets, buying opportunities, and the chance for the Fed to step in. Meanwhile, the beloved stock market that was once considered the safe haven for capital around the world, yes, our American capital markets, which must be protected from the evils of Bitcoin and crypto, well, guess what? They're trading like absolute shitcoins now. As you can see, Snapchat had weaker than expected earnings and dropped 21% in what looks like a click. As you can see, it's within just a few minutes here. Snapchat absolutely went to Hades. And to be honest, this is a drop that you scarcely even see from low cap altcoins in crypto. So this is crazy. And again, the facade of the cryptos to volatile narrative is wearing away as the pound USD market is now more volatile than the Bitcoin USD market. And that really begs the question, is Bitcoin a more safe and less volatile currency than the pound? But more to the point, because this is the crux of what I want to really dig in this episode. We've been going through this slow, teetering pain instead of real capitulation, real crashing, and real selling. That's what happens after decades of an up-only economy. People are unwilling to see the end of the bull market, and they just want to buy the dip and buy the dip. Stocks just made another massive green to red reversal. Meanwhile, the VIX is down another 1%, meaning it's not even as volatile as it could be. And what that means is that this isn't even panic selling yet. We're not seeing the panic selling or capitulation. And the Kobolesi letter here is saying this isn't even orderly selling. The real selling hasn't even begun, which is a really, really staggering and horrific thing to even think about. But when I started flipping bearish earlier in 2022, and I said, it's time to de-risk, it's time to get out of exotics, it's time to really consider getting as much cash as possible, people were already saying, hey, I'm already down bad. I'm already 50% down from my all-time high. I'm not going to sell now. And having gone through the pain of 2018, just let me realize the layers of how bad things can get. And so I don't want to be right about being a bear. I don't like being a bear. I absolutely hate it. But guess what? When you see how low things can actually go, all of a sudden selling back in March, selling back in April, selling back in May, all of a sudden looks like a really good idea. And not aping into every pump seems like a really good idea. Again, we're going to be following it closely, and we're just about at the point where I'm going to give you my 3 key signals that I'm going to look for to start buying again. So what's the issue here? Well, of course, it's inflation. It's not just debt, it's inflation. That's why we're raising rates. That's why we're forcing all of these mortgages up and crashing housing and crashing the markets. It's all about controlling inflation because it affects everyone. It affects the price of bread. It affects the price of gas. It affects the price of living, of basic necessities, which is way worse than a recession, which usually affects not everybody, but a more specific group of people. Again, recessions aren't good either. I'm not pro-recession here. I'm just saying inflation is actually one of the worst things that could happen. So we need to control inflation. Ding, that's checkbox number 1. But it's been super hard here. You have an economy that's like a 13-year drug addict that's been on heroin here, and they can't just quit cold turkey. You can't just come off of that cliff and just go stone cold sober. That's what it's like pulling all this liquidity out of the market after giving out free money to anyone and everyone for 13 years. It doesn't take a rocket science degree here to tell how different this slow collapse is from this jagged collapse in 2020 or 2019, 2018. These bear markets are nothing like what we're seeing right now. So now that you get just how crazy this is, let's talk about how this gets fixed. Well, the first thing we need to see is inflation starting to come down. Remember, this wasn't a liquidity crisis at banks. This wasn't subprime mortgages. This was inflation going out of control. So as inflation comes back within control, we can see some relief. So that's one thing that we absolutely must see is inflation starting to come down. Again, these are lagging indicators, year over year inflation. So people are predicting that by mid next year, we should see some really meaningful progress on inflation. That's part 1 that absolutely must happen. Part 2 that I'm looking for, and again, this isn't something that needs to happen, but it just feels like it's most likely, is that something's going to break. And something like the bond market is just going to go with no bids, and effectively the interest rates are going to get so high that no one's going to be willing to invest in anything risky if they know they can make 10% on their cash from the government. That would just ruin the entire economy. So what's the government going to do? They're going to start buying their own bonds. And they could even do it with policy by forcing government institutions, pension funds, or other institutions to buy those bonds, which would in and of itself change materially the dynamic of the entire economy. So the Fed stepping in and intervening on the bond market, that's number 2. If that happens along with inflation coming down, now the door is open to weaken assets like the dollar once again, and money can start once again entering in to the stock market, to the real estate market, and of course our beloved cryptocurrencies. And again, there's also a narrative narrative that I've talked about of the tensions between East and West that are emerging right now, making a completely independent asset like Bitcoin all of a sudden far more compelling as digital gold, an incorruptible and a completely independent resource like Bitcoin, making it something that governments see as worth hoarding, because of course that is something that no government can completely manipulate. Well, you know for a fact that some of the biggest oil producers in the world are not exactly the most trustful of the United States right now. We're seeing this with OPEC, we're seeing this with Russia, we're seeing this with China, and what we're seeing is that there's a big distancing happening from the US dollar. This is a huge multi-decade trend, but it's one that could favor and play strongly into the hand of Bitcoin. So here we have it, the controlling of inflation and something breaking, and then finally the government doing something to clean up those markets, whether that's yield curve control, easing monetary policy, any of those things that will be directly communicated. Those are going to be the bat signals that risk might start coming on again. Now, of course, we could see the Fed stutter step here, say they're going to do one thing, all of a sudden inflation comes back and they try to crush the markets again. It could be a very frustrating time. But I believe that even in a flat decade, if that's the worst case scenario, that technologies like crypto and specifically crypto within video games are going to continue to gain market share. And those are the sectors that I believe in more than ever. Again, I told this community that October would be a huge month for the project that I have founded, Superfarm, and I mean that. So keep your eyes fixated on my Twitter. You're definitely going to want to be following for updates. The team has not stopped working at all. There's less noise, there's more signal, and for that reason, the hardest, best working teams in crypto are going to rise like cream to the top during these tough times. I'm excited to keep fighting the good fight with all of you. If you guys enjoyed this, the fourth thing you can do to fix the economy is smash that like button, and of course, make sure you subscribe. We're going to be bringing on experts like Darius Dale. We're going to be bringing on founders, visionaries. We're going to be covering the topics that govern our modern world, and I believe we can make a huge positive impact here. Make sure to come subscribe and join in on my morning Twitter sessions, 9 a.m. Pacific time, Monday through Thursday. I'll be hopping onto spaces when possible. It's a really cool medium. I'm starting to really like it. As always, I hope you're well. My name's EllioTrades, and I'll see you very soon on the next episode.